this has been one of the most comforting things for us to kind of stumble across, and that's what I really want a lot of people to understand as well, is once you understand timing and why timing matters, it really takes a lot of pressure off you. And once you recognize that there's bigger things at play here than just your own choices, it really, really helps. G'day guys, it's Ben and Simon here at the Pumped on Property Show, re-released episode 2. Here we go. Super excited about today's catch up. Yeah, no doubt about it. Another good day. I always look forward to Wednesdays. Wednesday's the day that we record all of these things, and then they obviously need to get edited because we make a few mistakes.
Yeah, I mean, you guys see a lot of those mistakes. But, you know, it feels good. Like Wednesdays is definitely the day that I look forward to.
Hell yeah.
We just had brekkie. We just planned for the content we're going to do today. Super excited about today's podcast. But before we get into that, wanted to talk about where Simon and I have been at, because sometimes it's easy to see other people and think that they've got it all figured out. And sometimes we put off the idea that we do, but we fucking don't.
No,
you know what I mean?
God, no. Like, this week has just been, like, the last 7 days for me has just been a bit weird, and I've just noticed myself, you know, having shallow breaths and getting frustrated at stupid little things and just not being who I feel as though I truly am. And we had just had an awesome chat before brekkie, kind of talking about where we're at, and it's completely cool and normal to feel that way, feel a little bit stressed, feel a little bit anxious. But one thing that Tay and I are doing at the moment is we're doing like a 30-day learn how to meditate course.
I love it. Just
to kind of both get on the same page with it and learn these different tools and tricks, because with my meditation, I've always just kind of done it, but I've never learned how to do it properly. Yeah, and it's been really powerful to learn these different tools and techniques. But last night was a really, really pleasant one because I needed it big time. I was just feeling so in my own head and just couldn't overcome it. But learning these different tools and tactics was really great. And it was last night was about just kind of projecting happiness and positive vibes out to other people, and then realizing how happy that makes you when you project that kind of positive emotion and positive vibes, and then doing it for yourself. And it really helped get me back into kind of, you know, it's okay to not feel great 100% of the time. And if you can have that awareness to understand that you don't feel great and you need to do the right things, then it really works. And then this morning I just got up, and it was a beautiful sunny morning with a nice light breeze. So I just went out, sat on my yoga mat with my nice lemon tea and my gratitude journal, did a little bit of stretching and moving and breathing, and then sat there and did a big meditation where I was just kind of like welcoming in good vibes. And as opposed to doing what I've been doing for the last 7 days, which is attaching onto the negative thoughts and the bad vibes, I decided to go, okay, well, what are the good things in my life? And I'm grateful that I'm sitting in my own backyard with the sun on my face and the breeze in my back. I'm grateful that, you know, my partner is inside, and, you know, I've got such a great person to rely on to help me through these tough times. And I'm so grateful that I've got an amazing job where today I get to go to work and shoot some videos for my job. And it's just switching that mindset. And then I went inside, had a cold shower. We got taught this thing from this yoga teacher up in Palm Cove earlier this year.
Which is up in Cairns, and such a sick spot.
Oh, we were doing yoga like in the palm trees, like beautiful sunrises and things like this. It was so nice. But she just gets you to kind of shake out and like hum and just like get the bad vibes out and just change your state. So I'm doing this in the shower this morning and having a bit of a scream because it's freezing cold. And
it's just 28 degrees at the moment.
Yeah, it never gets cold up here, actually. That's so true. But then I was just kind of like really grateful that I can now change the way that I feel and recognize that I don't feel great, and then go, okay, well, what do I need to do? And just focus your mind on those things. So it's been really powerful, and I do feel pretty damn awesome after the last 24 hours, which is great.
I love that, bro. Like, I think something you said this morning that I really needed to hear, because same as you, like just being a bit hotter, like I call it hot, or a bit sharper than I normally would want to be or normally am. And you said that like when you learn to detach from your thoughts and realize that your thoughts aren't who you are, you know, that is a really powerful thing, that observing mind that you've been able to create for yourself, and you know, I've been working on for the last few years as well. And you know, we go through stuff, like I was thinking I have been a bit sharp, and then, you know, something you said, which is, well, you thought about why. Sometimes I don't think about why. Sometimes, like other people, I just get hooked onto the thoughts, and it's like, oh, poor me, I'm back in the anxiety hole.
You go to solution, right? Like that's who you are. You're just a, you know, problem solver. So if you feel like that, you're like, I need to fix it.
Yeah.
But sometimes, reflection is the way to fix.
Fully. Or just even creating space for it. And so like I was feeling pretty hot or pretty sharp, but you know, we're thinking about maybe selling our home and moving at the moment, which it's already my dream home. Like, so that's like, and I'm really emotionally tied to this place, which has been a big one. And then just some other stuff that's been going on. And in the business at the moment too, like we're working on so many back end things to make it better for clients. Like all of our process stuff behind the scenes, the emails that we send, training new team members, rebranding to make it look so sick, like actually really showing up in these podcasts and doing them the way we want, and planning for stuff. And all of that stuff, it's like the combination of vision meets logic meets creativity meets like how do we connect our message to the market, which is like we really give a shit and we also really know our shit. And it's just, it takes energy, and it's also stuff that I've been putting off that I've known I need to do for like 2 years.
Yeah, exactly. I swear we've been talking about it since I started working here. It's like, by the end of this year, I'll have it sorted. 2017 goes by.
2018.
19, but by 2021, we're going to be there. And it looks sick as well.
You know, I felt so good the other day. I remember at uni, and anyone that's gone to like TAFE or uni knows that sometimes you cram, and I felt like that on Tuesday. I'm like, I've just got to start, and I was so overwhelmed, but then one thing at a time, and like I'm halfway there already, and it's like an exciting thing. But you know, it's really cool to just be working on stuff.
The whole essay situation, it's like at the start of every uni semester, it's like, I'm going to do this, give myself plenty of time and make sure that it's done properly. And then 2 days before it's due, you're like, all right, get into it. And then you realize how simple it was once you just actually get started.
You know, like I at the moment have been like trying to train the team and also write this process stuff out. But it's also like takes a big toll on Simon as the other business owner, like, because he has to step up and do other stuff. So that's my motivation. It's like, well, I can't leave you hanging for much more than about another 2 weeks without supporting you on some of the bigger stuff you've been doing, without you starting to crack a little bit. So it's like, you know, I'm just getting it done now. And
it's good.
Done.
Yeah, hell yeah.
You know, today's video is going to be exceptional. This is one of my favorite things that I've learned. It's completely changed the way that I see the world as an investor. So what we're going to talk about specifically is timing, and more importantly, why timing matters, investors that we know and people that we look up to that have used it absolutely perfectly in the past. We're going to talk about this 18.6 year Phil Anderson and Fred Harrison cycle. We're going to talk about how you can use it to your advantage and exactly where we are in the current market cycle now, hopefully giving you a lot more peace of mind than the media will give you at the moment. And we're also going to talk about some great data sources that we follow that help us create logical or make logical decisions based on this timing stuff. Because when markets like the coronavirus come up, it sort of hooks into your emotional side of your brain, and it's like, this time it's different, this time it's changed. And we know the best investors, the Benjamin Franklins, is it Benjamin Franklin?
No. Benjamin Franklin is an exceptional human being, but I don't know how much of an investor he was.
I don't know why, I've just fully forgot the book is the Little Red Book of Investing, but I fucking can't remember the guy's name right now.
I don't know either,
but like the George Soros and stuff that's, you know, have those beautiful quotes around like, this time it's different. And as a human, almost like with how I've been feeling in the last week, it's like, no, this anxiety is different. It's like, I'm fighting with it. Anyway, we're not going to edit that out. It's not different. So let's sort of...
I guess this has been one of the most comforting things for us to kind of stumble across. And I that's what I really want a lot of people to understand as well, is once you understand timing and why timing matters, it really takes a lot of pressure off you. And once you recognize that there's bigger things at play here than just your own choices, it really, really helps. I guess, why don't we kick it off by talking a bit about why timing matters and how you stumbled across the book from Phil Anderson and Fred Harrison, The Power in the Land and The Secret Life of Real Estate and Banking.
I remember I used to like go down these wormholes of like just chasing an idea or data, and an idea that I was hooking onto in about 2017 was the market was going to crash. And I don't know why I'd got to that place, but I had, with the anxiety that I was feeling at the time. And so I was like 7 or 8 hours one weekend down this wormhole around trying to understand the market. What I was looking for was proof that it was either going to crash and I could make a decision, or it wasn't going to crash and I could make another decision. And I went right through like a bunch of people in Australia and America stuff, and then someone just had this link to this text at the bottom of an article to Phil's book, and I went to like a PDF version of the book and started reading it, and I'm like, whoa, like fucking game changer. I ordered the book straight away, and I ordered the other book, The Power in the Land, because they were both linked in the same article, and I read them. It took a while to read Phil's book and Fred's book because they're just so data history heavy, and I'm like a reader. Like I read a couple of books at least every single month, and it took me like 3 months to get through it.
Yeah, well, it's hundreds of years of history broken down into
hundreds of years of history.
Isn't Phil's book, how many pages? Like 700 or something?
Oh, more than that, man. Yeah.
Crazy.
It's huge. And tiniest text, like scientific fucking report text, like so much in it.
But
and
necessary.
A normal book has characters, it has a flow, it has consistency, where Phil broke history into 18-year chunks, and one 18-year period had completely different players, events, and history than the next one. So it's like, oh my God, that's intense. Oh my, you know what I mean? And it's just a big book to read. I'd recommend anyone that checks it out to go straight to the last chapters, read the synopsis of the history, and then if you're interested in history, then go back and take a look. But you know, I was like, I'm a super skeptical person by nature. Like, I don't really trust anyone until like they've like really delivered for a lot longer than they need to. And so I've followed Phil skeptically for like 4 years now, 5 years. And this guy has been like a fortune teller, and
it's ridiculous.
I still don't believe in it. I still don't 100% agree that forever, but I'm like, until proven guilty, like I'll keep going with it. So I've got this like positive skepticism that at any time it could be proven wrong, but I'm also like so comfortable with the cycle now. Like I really enjoy it. I like it. And you know, I think there's so many, not so much the timing of it, which we'll get to, but more the way that certain events happen in a certain order, and it gives you a gauge of where you're at any one moment in time based on hundreds of years of history.
Yeah, and detaching from the specific event and just realizing the fact that it is an event that triggers some sort of reaction.
So why timing matters is I went and caught up with Phil in 2019, I think it was October, in Melbourne, and he said it's time to get out of the stock market. The risk is now outweighing the potential reward. And he's like, the market will go up by another 10 to 15% right now, which he calls the winner's curse, which is like Bitcoin or stock markets or property markets like Byron Bay right now, for example, going feral and everyone thinking that it's going to continue forever. And then he said, get out. And so I rang my mum and my dad at the airport, and I said, Mum, like, I've been saying this for a little while now, but it's looking real bubbly. Like, he's pulled every cent that he had out of the market. That's how much he believed in it. And
Buffett pulled it out in October last year as well.
And at the same time, I read the Bloomberg article where Buffett was sitting in $125 billion in cash. And I said, if him, you know, who's the guy from Bridgewater again that we absolutely love that wrote
Ray Dalio.
Dalio was out in cash, and so was Phil Anderson. I went,
these are the biggest guys that we know in the game.
Yeah, these like the two most successful investors of all time. Dalio being number one, Buffett being two. And And mum listened and she pulled the cash out. She avoided a 50% decline on her stocks, and then she rebought at the bottom, and now she's killing it.
Mm-hmm.
Dad didn't listen. It wasn't the first time I told him that I thought it was like this, and I was early in my thoughts as well.
I know where you get the distrust from.
Yeah, for sure. But he didn't, and he got belted, and now his has come. Like obviously it's rebounded very strongly too. But why timing matters and why that's important is if you can avoid in the stock markets the once every 7 years smashing, 7 to 10 year belting, and if you can learn when to buy stocks or buy properties at a bottom, not just as your only strategy, like time in the market is the most important thing, but if you can learn timing as well, absolute game changer. Like I've worked it out for myself, like my average return by using this strategy should be percentages per year better than people that don't use timing to their advantage.
Exactly. And what we're doing here is trying to get the best return on our investment. We're not just investing for fun. We invest to get good returns. That's what we're doing. So if you can maximize those returns by getting into the right markets at the right time, it's going to put you in a far better position, both from a monetary perspective, but also psychologically as well. Like when you crush it, it feels pretty damn good. I haven't had it yet, but I've seen it happen to other people, which we're going to get into.
Yeah. So, a couple of examples of using timing. So let's say that it's 2011 right now. Everyone in the world is saying don't buy, but you go, you're me. I've just come out of uni. I've got no idea that we've just been through the second worst depression in history, or like since in this century. And I'm all like psyched up to buy a property after reading Rich Dad Poor Dad, and I go and buy something in Sydney in 2011 and then something on the Central Coast in 2011. Now, unbeknown to me, that was the perfect year because Sydney up until that point hadn't grown in value for 9 years when you take out inflation. We're also in a market where no one else was buying and there was massive supply from people that had been forced to sell in the GFC. Now, I didn't know those things, but looking back, it was crystal clear that 2011 in Sydney or Melbourne was the perfect year to buy. And then I sold out of the Central Coast in 2017, which was at the very, very top. I'd actually probably just mistimed it. 2016 was the top for me.
You timed the Central Coast perfectly. Sydney's top was probably 16, end of 2016, when Mum sold her unit. But Central Coast, the ripple effect, it was sort of a little bit later.
Yeah. Now, as a business, we stopped buying Sydney back in 2015. I thought that there was no value there anymore because I could see that 17 was coming. I just knew that it wasn't a time to sell out yet. And the reason I saw that was because I was already aware, even though I didn't have the fill stuff, I had the core logic and SQM stuff that we'll talk about more in a moment. So, that was a perfect example of timing, buying at the bottom, selling at the top. I bought for 213K and I sold for 550 or 600. I can't even remember now, but it was a really insane gain. Like it was almost a 200% return. That property just resold for 450 or 480. Like the guy's lost 100K since he bought it from me.
Okay.
So timing is super important, and that was my first experience without knowing it, that I was buying at the bottom, but I definitely knew I was selling out at the top.
And two things that I want to mention there as well. 2011, according to everyone, was a terrible time to buy. And if you were listening to the news, if you were listening to the major media outlets...
Every person in my life said, don't buy, what are you doing? You're crazy.
And then when you sold in San Remo, that's when a lot of people were like, you're crazy for selling.
Everyone was like, what the hell are you doing? Like everyone was buying and paying ridiculous money.
This is the psychological effect of these sorts of times. And Warren Buffett said it best. It's be fearful when others are greedy and be greedy when others are fearful. And, you use that to your 100% advantage in that one.
Yeah. Now, Fred Harrison, who studied the UK property markets for 350 years and actually figured out this cycle, or one of the early guys to figure it out, wrote a book called The Power in the Land in the 1970s that predicted the 1980...
I can't remember.
I think he wrote it, maybe he wrote it in the he wrote it in 1983.
He wrote two.
And he called the 1990 recession 7 years before it occurred to the month. Then he wrote Boom Bust. I think he released that in 2005, calling the 2007 global financial crisis. These books were published 7 to 2 years before these events, and it was just crystal clear to him that it was coming. Now he's saying the next top is like 2026 and the next bottom by about 2030. Whether that happens or not, these are super interesting guys. So the reason I talk about Phil and Fred is when I was catching up with Phil personally off camera, he talked to me about timing, and I said, well, what did you do in the last GFC personally? And he said, I, after all of my research and history, thought that Australia was going to crash. We didn't. He said in 2008, I went into cash, and he said I was waiting to buy, but Melbourne and Sydney and everywhere else continued to go up in value, and he couldn't find value in Australia outside of the stock market that did drop by 50%. So what he did is he packed up, left Melbourne and flew to London, which did crash by 40%. And he started to buy up development sites in the city, which he held to the end of the first part of the cycle and flogged them all off in 2017-18. So that's another example where he made millions of dollars by doing that. And then I went and saw Robert Kiyosaki, I think it was when he came out to Australia with Tony Robbins in 2011. At the time, I couldn't understand it because I didn't get it. But he's like, now is a once in a lifetime opportunity to buy American properties. They're at 50 cents in the dollar. He's like, it's also a great time to buy gold and silver. You should buy it now. And I remember the gold price has doubled that year. And obviously since then, the property prices have gone up by 100 to 200%. So he understood timing and cycles back then. He was telling everybody on stage to do it, but I was like so skeptical and I didn't know anything about it, that I just thought he was another get-rich-quick guy. I didn't realise that he, like every big investor, gets timing and gets cycles.
I actually saw him last year in 2019, and it was just one of those Success Resources events as well, and he was still harping on the same thing. He sees there being a huge crash at the end of sort of the 2020s. So exactly in a line with Phil Anderson and Fred Harrison's cycle.
You said he was smashing on gold last year as well too, because he knew the stock market was going to crumble.
Exactly. He was saying, get your money out of cash, get your money out of the stock market and start buying some precious metals or cryptocurrency, he was saying at that point in time. And that was after the big Bitcoin drop as well.
That's when it was like 4 to 5. Now it's at 16 again.
I think even higher.
So, you know, the thing about timing and cycles is so many people are skeptical of it. The reason being, and I now realize most people, and we speak to a lot of people, like we would be speaking to 1,000 to 2,000 investors a year now with our previous clients, current clients, and future ones. And there's two things that most people I speak to can't do, even very successful business people, and that is see the future clearly and where exactly they want to be and commit to that. Like, just commit to it. You don't have to know how to do it. Just set the intention. And the second thing is, what me and Simon have learned to do is see patterns in unusual events and logically understand that they aren't actually unusual when you look back long enough in history. So I'm one of those people that learns from history to make better decisions moving forward in the future. And so from there, if we get into this 18-year cycle explained, the simplest way to explain it is it's roughly 14 years up of growth with 4 years of negative market. Now, what it normally looks like if you were to draw it on a graph, and I'm sorry that you can't see this right now, but that's cool, is somewhere between 7 to 9 years up. Then we hit this mid-cycle point, which is a pause or a small decline in property prices historically with a large decline in stock markets. Like, historically, stock markets have dropped by, 40% in the mid-cycle slowdown.
Exactly.
Property prices globally generally sit flat, go up slightly or come down by maximum 15%. And then we get a second period of growth, which lasts again somewhere between 5 and 6 years. We get a period at the very top called the winner's curse, where it goes absolutely feral. Think Bitcoin when it went from 10K to 26K in a couple of months. And then we get this serious decline that doesn't just affect stocks, but it also smashes property prices. Now, in the last 200 years in America and Europe, the average property price decline at the top, 38%. Average stock market decline, 50 to 60%. it's important to know these things, because if you can avoid that decline, or if you have a strategy like Simon and I, where we'll hold some of our properties, we'll lose 30% in those years, happy days, because we're holding them for 30, it doesn't matter. But for those people that are trading more short term, or using the cycle like Simon and I do with other strategies to make, 7 to 10 year money versus 30-year money, really important shit to know.
Definitely. And there's certain triggering events that Phil talks about at different stages of the property cycle that can kind of give you a little bit of an indication around what could potentially come next. So one of the really interesting ones that we've just been learning so much about, because we're going through it, is the mid-cycle slowdown and certain triggering events that have occurred there in the past. So this year, Phil was talking about a decline in March in the stock market 3-4 years ago.
We knew that this was coming. Like, he told me in 2018 to start preparing.
Yeah.
He told me in 2019 it's time to get all of your ducks lined up and in a safe position. 2020, he called it to the month.
Called to basically the day. I think he said 20th of March in one of those articles late last year.
So what Simon's talking about with the triggering event is an event, and none of us ever know what's coming because it's always different. So let's talk about the previous events.
Yeah.
This one will be called the coronavirus.
The pandemic, exactly.
The one before that
was the Twin Towers coming down, so the big terrorist attacks.
9/11 and the dot-com boom bust.
Yep, exactly. Prior to that was the 80s. The
recession that we had to have.
Yep, exactly. Previous to that...
Because of interest rates getting to like 15 to 17% globally.
Yep. And then previous to that was the Cold War.
The Cuban Missile Crisis.
Exactly.
There's always a triggering event that creates fear in a market. Now, why that? Every single year there's something that scares the shit out of people. But the difference is, by the time you've gone from the last GFC to the next top before the mid-cycle slowdown, people like Warren Buffett, Ray Dalio already know that growth doesn't last forever. Everyone's doubled their money in the stock markets, and lots of people have doubled their money in property already. And it's getting bubbly. And it's like the earnings of the companies and the values of the properties no longer reflect actual market values. They represent speculation. And so this triggering event comes through, and the market's already nervous, and then the herd moves the other way. But as the herd moves out of the market, the people like Ray and Warren and us and Phil run towards it, because it is a once-in-a-decade buying opportunity if you can learn to see it like that.
Which is what we've been talking about in 2020 for property purchases coming into this second half of the cycle.
I mean, we've been telling people about 2020 since 18 or 17 on camera. It's for anyone that's been listening to us for a long time, completely knew that this was coming.
Yeah. And
you'll know early because of our connection with Phil for the next one, hopefully, or maybe not. Maybe we'll all get blindsided and wiped out, but I hope that's not the case. So there's some things that happen in the mid-cycle part of the cycle that is very different to the top of the cycle. Now, some of the things that we've observed is, and now I kind of get why there's a mid-cycle and a top. What I've noticed in the mid-cycle points is that the governments around the world, like we've just seen, will do absolutely anything necessary to pull their economies back into a positive position. Now, Ray Dalio talks about it in his book, Big Debt Crisis, which also looks at 100 years worth of cycles around the world. And he says that they start doing things like quantitative easing, which is printing money. I think the Australian government, after the Reserve Bank meeting this week, is almost committing to another 100 billion.
Oh, yeah.
On top of the 90 billion they've already printed in 2020. They do helicopter money, which is what you see everywhere, where they're dropping money on businesses right now. JobKeeper. They're also dropping money into certain industries with grants, stimulus packages, and they're also dropping money into individuals' bank accounts. But they're dropping it into the individuals with the lowest incomes, which are the most likely to spend that money. Then, on top of that, they start to reduce interest rates, which take the pressure off certain households, which create surplus money that gets reinvested in the economy. Then they start making money easier to access, and they talk about spending money on infrastructure. Now, all 5 of those things are happening in every single developed and undeveloped country around the world right now. And it takes time to get the wheel going again. Now, the difference between a mid-cycle and end of cycle, from my perspective watching it, is governments can get in debt right now.
Because it's been 20 years.
It's been 20 years since they had a last big thing. And a lot of them, including Australia, like Australia in 2019 was getting close, like a few years away from a surplus.
Yeah. Well, it was a surplus at the start of the year, wasn't it?
Some fucking dodgy accounting. But yeah, like they said
surplus coming into a recession year.
Yeah. So it's like they're in a healthy place, certain governments, or they're in a low debt place where they can just go into more debt. Now, you think another 6 years from now, I think they're saying Australia will be in between $700 and $900 billion of debt. There is no way that banks around the world, because they still have to get their money off international banks, or they have to print more money, which can devalue all sorts of things. And they're not going to be able to get into debt then. And that's the difference. In a mid-cycle, the governments will help us get out. At an end of cycle, the governments are over-leveraged, the banks are over-leveraged, and most people are over-leveraged based on false economy of I'm on paper wealthy with my stocks and properties, and there's no one to bail anyone out. Or maybe the biggest banks get bailed out, but everyone else and some of the major banks even go under.
And with these cycles as well, they last long enough for people to forget. 18.6 years is a long cycle. So it makes people forget about what happened in 2008, especially after a mid-cycle slowdown where people think everything's going to come crashing down, but then it doesn't, and they get all of these bailouts, and then everybody starts making money, really good money. People forget about what's happened in the past, which essentially keeps this cycle moving.
I'm so glad you said that, bro, because that is super important. Now, if we weren't emotional people and we were logically looking at 2020, from a health perspective and from a lifestyle perspective, it's been extremely brutal. If you're in tourism, if you're in hospitality, if you're in retail, it has been a horrible year on the back of other pretty bad years before that too. And for those people, like our hearts go out to you, because I know there's a lot of people hurting. But if you look at coronavirus in Australia, 100% of people feel like they've been affected by it financially, but only 15% of people really have been. And so what Simon's talking about is people remember the GFC because fucking houses in Bondi at the time were selling for 40 cents in the dollar. People remember it in Noosa because 1 out of every 3 properties on the sunny coast in Noosa was being sold by the banker's mortgagee in possession. Hundreds of people lost their tens of thousands of people lost their houses, businesses, and Australia didn't even get hurt. 60-80% of Americans were affected by that because there's no government intervention in the short term. There's a couple of bloody years. And so I think what you've said there's super, super important. I forget.
Just the fact that people then forget. So yeah, the living memory, exactly.
By the time we get back around it, if you're looking at this objectively, most people go, yeah, the stocks dropped by 40%, but I got back to break even within 2 years. My property, lost 5 to 10%, but it didn't really go bad. And then it's like almost 20 years, 15 years since the last major decline. A lot of the people that remember it are no longer in business, no longer in investing, no longer in markets. We just forget that these things happen. And then people go, this is an isolated event. And it's not.
And new people come into government, new people come into the banks and start changing regulations there as well. So you've got fresh blood and people that have forgotten what has previously happened as well.
So one of the key things that's just happened in Australia or about to and happened in America in 2018 is generally just before the mid-cycle or just after the mid-cycle slowdown, we get a reversal back to a previous greed-based system. It's like, you hear it from the Treasurer in Australia at the moment and the major banks. The responsible lending laws are killing the Australian economy. Developers, business people, mums and dads and investors cannot borrow money. And so they go, well, let's just make it easier to borrow money. So what Australia did after the GFC and every global country did, developed country, is made it really fucking hard to borrow money. And what they did at the same time was like pump billions of dollars into the economy to get it restoked back up. But it's been very difficult in the last 7 years to access money compared to the 7 years before it. And so what we're now seeing is the Treasurer coming out and saying we're going to scrap everything that we put in place after the Royal Banking Commission. And not just that, we're going to reverse all of the stuff we put in place to protect Australians after the last GFC from banks. In America, as soon as Trump got in, within a year, he'd reversed every single thing that Obama put in place to limit the bank's ability to create false credit and lend to people irresponsibly after the GFC. Now, those things don't have an effect and they don't really make the headlines of the media, but they will have a massive effect in 5 years' time because people that shouldn't have been able to borrow money will borrow it. People that want to speculate and jump in on the short-term gain will jump in, and those people come unstuck at the top because interest rates will not sit at 2 to 3% forever. They will be back at 5 to 7% within the decade.
Generally, what happens at this winner's curse is it is so easy for everybody to secure finance and buy assets that every man and his dog is in the market. So no longer do you have the strategic, successful, smart investors in the market. You've literally got everybody in the market, and with these laws being abolished, it puts 100% of the responsibility onto the borrower, not the lender, so that when it all comes crumbling down, it's the mums and dads that are the most affected.
Yeah, so the banks go flog off the properties, clear their balance sheets over 2 to 3 years, and then we get past the low in the market and we go off again. Now, I think it's important to talk about where we are in the current cycle so that, people can feel like the way that we do, which is super positive about the next 5 or 6 years.
So according to Phil, right now we are well and truly in the middle of the mid-cycle slowdown. The end of the previous cycle was 2012, so 8 years later, smack bang between basically the middle, we're in the mid-cycle slowdown.
Yeah, now these mid-cycles from Simon and my analysis last about 9 months to 2 years on average. But, Phil sent us an email last week, as he did to his other subscribers, and I highly recommend jumping on his Facebook page, if nothing more. Sort of saying that some of the early indicators that he watches out that we're moving through the mid-cycle are starting to show themselves, like looking at building stocks versus bank stocks and stuff. And I'm not going to get into all the data, but we're slowly starting to work our way out of it. And you're seeing that with vacancy rates coming down, demand increasing again, DSR scores going up. For the first time in a year, Australian property prices moved by 0.4 of 1% last month, according to CoreLogic. Things are slowly starting to feel a bit better again.
Yeah, what's happening at the moment is owner-occupiers are flooding and controlling the market right now. And it's going to be super interesting once the investors get their confidence back and start coming back in as well.
Yeah, I think we're at the lowest number of investors currently in the Australian market that we've seen in 16 or 17 years.
Yep.
It's 20% of people buying are investors. I love that.
Yeah.
Because the emotional mums and dads are the ones that drive prices up, and that's what we're starting to see. In some areas, I know clients in Byron that have made $600K profit this year. One of our clients, inherited a home that he put up for sale. Now, from the date that he put it up for sale in July, he got an offer at 1.4 or 1.5 mil, this beautiful big acreage property. By the time he sold it a couple of months later, it was up to 1.8 mil.
Wow.
He made 400 grand just by waiting a couple of extra months to offload the property.
I've felt it up here with my purchases. We've seen it as well, in some of the beachside suburbs up here on the Sunshine Coast are jumping 10% over the last 3 months.
Yeah, it's interesting. So that's sort of where we are now. What's most important is how you can use this stuff to your advantage.
Yeah.
For me, Simon nailed it at the start of the video. It has created a calmness and a strategy for my investing that I never had before it. It's enabled me to feel confident when others are uneasy, and to not get, I still get emotionally caught up at the start of the virus. It really freaked me out for a couple of months until we figured out how bad it was going to be and where we were. But it's enabled me to sort of continue to invest with confidence this year and last year without stressing out about what everybody else is saying is coming.
Yeah, 100%. And one thing that we wanted to kind of talk about is what we've realized when sort of unpacking the data. And this actually got confirmed from one of his right-hand man, Akhil, talking about larger markets after a major GFC and then smaller markets after a mid-cycle slowdown. So Akhil went on to say that the property market in London, England, had gone absolutely crazy out of the back end of the major GFC. So similar to what's happened in Sydney and Melbourne. And now what he's starting to see is that rollout after the mid-cycle slowdown into some of these smaller capital cities around England, like Liverpool and Manchester. And we'd actually looked at the data, 50 years worth of data here in Australia, in Sydney, Melbourne, Brisbane and Perth. And when we overlaid this with the 18.6 year cycle, what we found is that out of the big GFCs, Sydney and Melbourne typically perform quite well.
Really well.
Quite well up until the mid-cycle slowdown, and then generally post the mid-cycle slowdown we see other areas in Australia like Brisbane and Perth go absolutely bonkers.
And I think it's setting up the same way, which is why Simon and I are actively buying Brisbane right now as opposed to Sydney or Melbourne. You know, it's pretty clear that Sydney and Melbourne since the GFC went up by 60 to 100%. But then when you look at Brisbane, it's cheaper according to CoreLogic than it was 13 years ago to buy right now. You look at Perth, it's cheaper to buy now when you factor in inflation than it was 14 years ago. People are starting to move to those markets. Vacancy rates have finally declined. All of the extra stock that was in Perth CBD and Brisbane CBD has been absorbed in the last couple of years.
It's been huge infrastructure projects being approved all over Perth and Brisbane, southeast Queensland.
You know, what's getting Perth back on the show on the road, and I've been talking to a lot of clients that are living over there, is with this whole lockdown law, people couldn't fly in and fly out from other states. So a lot of people have just decided to move to Perth, or their companies have relocated them, and it's created this massive short-term population spike, which has taken vacancy rates from 3% last year to under 1% now, which is like a very early indicator of what's to come next. Like when there's no rental or housing accommodation available and no new supply coming on, like there's no new supply in Brisbane or Perth, it's just an interesting thing when you overlay population growth. Now, what I historically have seen on top of the secondary cities doing well in the second half is a massive migration to secondary cities. And the reason I believe it occurs is because in Sydney and Melbourne, and this has happened in the past too, houses get too expensive to buy relative to income, or rents get too expensive to live, or the average incomes in Perth and Brisbane are now higher in both areas than they are in Melbourne, and just a little bit behind Sydney. And it's kind of, you know, when property prices are at 50, 100% cheaper in Brisbane than they are in Sydney and Melbourne, and the same in Perth, but incomes are the same, it means you can effectively double the lifestyle that you can achieve up here, or the quality of home that you can have up here for the same money, without putting that massive down the line pressure of having $1 million loan.
And this happened after the mid-cycle slowdown last time. It sort of took a little while for it to get into Perth and Sydney, but last time after the mid-cycle slowdown, we had...
Perth and Brisbane?
Yeah, Perth and Brisbane. You had the massive mining boom, which we saw Perth go have really strong capital gains.
140% growth in 6 years.
Yeah, and then Brisbane also took a little bit longer for it to get here. It was sort of from 2004 up to close to 2008. Absolute insane gains. I think it was something like 80% or something over that short period of time as well. And what was happening at those times up here in southeast Queensland, you remember, because that was around when you moved to Queensland.
Yeah, I came up in 2006 and there was 1,000 people moving up.
Yeah, and it's looking like this could happen again. Was it Lisa's friend down in Melbourne?
Yeah.
She's applied to move up to southeast Queensland once the borders open back up. And when she was talking to the government, they told her that there had been 20,000 applications from people in Melbourne alone that are looking to move to southeast Queensland. I think I've talked to probably 10 people in the last month based down in Victoria or New South Wales that are asking for help to buy a property on the Sunshine Coast or in Brisbane to relocate themselves as well. I don't know if they're included in that 20,000 or if they're on top of it, but insane
it's
numbers.
Cheeky what the government's done in Queensland too. They've said, we'll let you across the border, but you either need to have a rental in your name or a home that you own in your name before you can legally come across. And I've seen vacancy rates go from 2% to 0.5% in 6 weeks. I've seen DSR scores go from 55 to 75 in a month. It's incredible short-term pressure. But, when you start to understand cycles, we knew it was coming. Like, we could see it. Brisbane has been, and Southeast Queensland has been the fastest growing population market in Australia for the last 3 years straight from an Australian perspective. But that's just, if you understand how populations migrate, it's also important to understand like where super money's at, and the fact that a lot of people within a year will have recovered their money from the last GFC, and they wanted to retire 10 years ago, but now they financially can. They're moving to Hobart, they're moving to Perth, the Sunshine Coast. They're moving to these markets, northern New South Wales, that represent more affordable and better lifestyle buying for them versus like where they are at the moment. It's crazy, this stuff, and it's so powerful.
Exactly. And, that's why we're investing in Brisbane right now, because it's coming into that phase of the cycle where it's typically performed really, really well. And then once we top out, if it all goes to plan and we do have well, not plan, but if it all does unfold if history repeats, in 2026, we start to see a bit of a fallover and potentially a new cycle starting 2030. At that point in time, we'll be looking down to Sydney and Melbourne to take advantage of those markets at that point in time to maximise the potential in the first half of the cycle.
So last time round, I think Sydney, just after the GFC, had been flat for 9 years. So it wasn't, two things happen I've now realised with property prices, right? You either get a boom and a bust where prices come back by 30% in a couple of years and it resets and it's affordable to start it again. And that's, as bad as this is to say, that's actually a better outcome. The other outcome is what's happened in Brisbane and Perth and Sydney before that, where instead of getting a quick decline to like restart a cycle,
like the stock market. That sort of happens in the stock market.
You get this period of, deflation effectively, where the market sits completely flat or does nothing for 9 years, but with the 2 to 3% per year of like inflation, effectively it's the value of money's increased by 30%, but property prices haven't changed. So it's almost like the property prices have declined by 30% over the same period. And what I've realized is that whether it's a short-term rip the Band-Aid off issue or it's a slow burn, and it's painful for people that bought in, Melbourne, Brisbane or Perth 10 years ago, because it's like no one has made money.
No.
In fact, a lot of people have lost a lot of money over that time. But understanding these things as an investor for me and for you means that you can make more strategic decisions. So I will always personally, if the cycle continues, buy Sydney and Melbourne after a GFC, decide if I want to hold it forever or hold it for 7 years and make good coin, get out safely, and then reinvest in the secondary markets. And that'll be my strategy globally. And it's the same thing in London. It's the same thing in Singapore. It's the same thing in New York. And the more that the world comes together from a globalization perspective, the more the cycle unfolds in a familiar pattern.
The bigger that they get as well. And this is something that Phil has pointed out. As cycles repeat, the expansions and retractions become bigger and bigger and bigger, because you've just got more money, a more globalized market as well, which is obviously only going to get bigger and bigger and bigger as we move forward.
What did you say the other day? It's like been an $8 to $12 trillion bailout so far in 2020, which dwarfs the GFC bailout. But there's significantly more money with China and India and Russia in the pot now as well. Yeah,
and this has just been created out of nowhere. I was listening to a podcast last night from the guy that wrote Sapiens, and he's like, fiat currency doesn't even exist anymore. He's like, in this, a guy at the RBA in America just put an extra couple of zeros on the back of some transfer and just poof, $1 trillion. Like, just crazy stuff.
Yeah, that's exactly, we're not getting into
there's
a lot
too
of
much.
stuff there.
I would obviously recommend going out there and investing in buying The Secret Life of Real Estate and Banking by Phil Anderson and The Power in the Land, just to have that awareness. And if you don't want to do that, at least watch their YouTube channel and follow him on Facebook and things like that, just to get those insights, because it's definitely helped us and given me so much confidence. Like at the start of the coronavirus, I was a little bit nervous and whatnot, but then as we started to see some of the data unfold and some of the articles from Phil come out, it was like, okay, cool, we are in the mid-cycle slowdown. I shouldn't expect any drops in the property market, and it was essentially the right time to be buying.
I bought a place for at least 60 grand below market value at that time, and so did Simon. And both of them have gone straight back up now to where they were, back in December last year. Yeah,
like one of my, the property that I bought in June, one of my colleagues, Hayden, was just showing me some properties because he's looking at buying in the area, and properties that are in far worse condition than mine are now on the market for like $20,000, $30,000 more than what I paid for mine. So it's happening. We can see it.
So in terms of like some other good data points that we follow that help us understand this stuff, I love CoreLogic's monthly market update 10-minute video on YouTube. I also subscribe to CoreLogic and SQM, which are the two largest data collectors or aggregators of data in Australia. We do follow Heron Todd White's month in review report. That's more of like a snapshot exactly where we are now, and that clock that they use for residential housing will bounce at all different times of the year based on where that city is that month. Like last month, Sydney, Melbourne could have been declining. This month it could be rising. Next month it could be top of market.
Yeah. I can't find the consistency, which is a bit of a weird one, but I think what we've got to do is take it
at that moment.
Short term, exactly. But it's also really cool because they link it to some... So they'll do a full month in review and they'll look at the entire Australian property market. Then they'll write an article or a report, basically. And they're all on different things. Sometimes on the top end of the market. Sometimes it's on just houses. And it's just cool to read these different articles from different resources. Take a little bit from everyone, but as always, with a grain of salt, and then, just trying to compile all of these different little pieces of information together so that you can make the most of it, take advantage of it.
What this has helped me understand is when to leverage up, when to reduce my risk, when to be in cash and when to be in assets. And there's no, direct science here. Like, you've got to understand that, these 18.6 years, sometimes it's looked like 16, sometimes it looks like 22. But certain things happen with the manipulation and movement of money around the world that have been happening for hundreds of years in different ways, whatever the currency of the time was or the commodity was that created cycles. It's really interesting to learn. There's another awesome doco that I watched on YouTube called The Ascent of Money by Niall Ferguson. Just a cool way to understand currency and how we ended up getting to the last GFC. And I think it's really well produced as well. It's in like 6 or 7 little snippets. Fascinating watching. But we wish you all the best with this. Like, we always want you to be safe. The more you learn, the more you can earn. And I used to think that was a crock of shit when I was younger. I was just like, but now I think it is so true.
Knowledge is the best investment.
I know, just in investing in yourself. I remember Brian Tracy used to say this when I used to listen to him. He's like one of the Tony Robbins or Jim Rohn guys from back in the day. And he'd be like, if you want to create a life that is like a standard residential home, because he was a property guy, build a 6-inch slab or a foot slab, and that'll be enough to put a 1-story building on. But he's like, if you want to build a life of character, of depth, of financial freedom, of wealth, then you need to build a foundation which is far deeper than a skyscraper needs, which in some instances in New York could be as deep as 10 or 20 stories. And it's like, I really took that to heart 10, 15 years ago when I was listening to it. And I just constantly invest in myself. Documentaries, on YouTube shit, books, sometimes podcasts, sometimes not. Sometimes podcasts just wear me out. But, I love learning stuff. I love like collecting different ideas and subscribing to a few different things and having conversations that we have every week with our clients and learning from each other. And, you know, I don't necessarily want to go to the point where it's like your whole life is chasing wealth like some of these guys. I'm not prepared to put the 100 hours a week in. What I want is choices for myself and my family. What I want is a system that consistently works without freaking me the fuck out all the time. And what I want is a great lifestyle sooner in life. And property has been my ticket out. You know, Simon and I are both working still towards replacing our income through property, which we'll both do over the next 10 years. And Simon will be 35. I'll be 45. And that's a nice position to be able to choose how you want to spend every moment for the rest of your life. And we want the same thing for you guys.
Yeah, just having those choices at an earlier age. And that's all it is. It's choice. It's not we're going to stop working or we're just going to, you know, retire on a beach sipping pina coladas. Like, it's a
pina colada.
Let's go get caught in the rain.
I want to get caught in the rain.
And I just, want choices to be able to do whatever you want, whenever you want. And I don't know, I guess there's a bit of ego chasing the story for me as well, which is always nice. Like, to be able to consider myself financially free at 35 would be a pretty cool story.
I was just thinking about Jim Rohn, how he talks about his story, and he's like, at 25, I was broke. By age 30, I was a millionaire.
His voice is so good, eh?
I was a millionaire. If I can do it, you can do it. And I'm just like, fuck, I love you, man. But the world's changed in 40 years.
It has. And it will change again in 40 years' time from now. And that's really the only constant is change, but there is clues.
For sure. You know, the best thing I've ever heard from Phil Anderson was, you can't forecast the future, but you can remember the future. It's like, remember the future from looking back at the past.
I love that.
And I think if we did that as humans, like, that's one thing why we've never gone into another world war, because there's such a documented history. Like, I was watching a documentary on Winston Churchill the other day, and he ended up writing like 40 books, but he spent a big chunk of time after World War II writing all about it and working super hard to put some stuff in place to make sure that if this ever happens again, people have a living history memory of it. Like, hey, we never want to go back to this. This is what we learned, and this is how bad it got. I can't imagine how hard that would have been for him to have wrote about it after living it and after he was frontline in World War I as well. It's just that, you know, there's a higher purpose, and, you know, that's what financial freedom really creates. Not just choices, but for you to be able to get to that top of the funnel, which is self-actualization, contributing to the world in a better place, helping people, becoming the best father, partner, mother you can be, like becoming the best version of yourself, because your fear and the fear in your mind, which is always going to be there with financial freedom or not, but at least it's one less thing to fucking worry about.
Yeah.
You know what I mean?
That's just one less thing I need to worry about. Wise words of Tom Hanks in, what was it? Geez. Forrest Gump. You know, that's just one less thing, you know, I need to worry about.
He bought this company called Apple, and now I don't have to worry about money anymore.
He bought this vineyard. So good. And that's, you know, that's what we're doing. But really,
I've loved this today, man. It's sick. I hope you guys have enjoyed it too.
Yeah, thanks so much for sticking through this one, guys. I think it's really important. It's hands down the most important thing that we've ever learned, and we're going to continue learning and continue talking about it. And as this cycle unfolds, continue watching these podcasts, listening to the podcast and watching the videos, because as it unfolds, we'll definitely continue updating, going, Phil was right again.
Yeah. You know, for those of you who haven't already done so, please subscribe and give us a review.
5 stars.
5 stars would be good. And for those of you who aren't following us on Instagram or subscribe to our YouTube channel or on Facey, we share completely different stuff across the different channels. We'd love to continue to hear from you. We would love you to book a strategy session in with us when the time's right for you. We'd love to help you continue to invest with confidence and to take advantage of the current market over the next 5 years. So we wish you all the best. Stay safe with whatever you're doing, and thank you.